when you could mix business, profit, and income, and you also mix that with the spiritual essence of service to the community, service to others, not at the expense of yourself, together, and helping them get stability and helping them create, bringing affordable housing and investments to these neighborhoods, you're really tapping into something it's just more of a higher perspective. You're giving back more, you know that you're making a difference, and you know that you're being in service to humanity. So I do find that when you can not only be profitable, but also do so much more for people than anyone else has done, create a different narrative that really helps people other than yourself, have long-term secure housing that's in decent shape because you're not a slumlord, you're really giving out good karma, good dharma, and that does pay for itself, not only in the people you're impacting, but the impact you're leaving on a neighborhood or location. If you are this faceless machine, that's what you get back. If you are someone who's a landlord, and my tenants haven't even met me, but they do know if they put in a request for something to get fixed, it gets fixed, right? They know the energy. They know when they walked into the place, it might be in a modest neighborhood, but I took the time to put contact paper on the countertops, which is a very low cost way of upgrading the look, right? They see these little signs of the luxury vinyl tile instead of like that office flooring, which is really cheap. They see these little signs and energy. And so you really do get back what you put into it. And sometimes it is these small little touches, which shows you how important connection is for everyone to be fruitful.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. I had a couple of episodes recently about foreclosures, and I want to wrap up that series by talking to Lisa Phillips, who's an investor who helps others build profitable rental property portfolios by investing in foreclosures and other properties. Through her website, affordablerealestateinvestments.com, Lisa Phillips helps Black professionals build profitable rental property portfolios. Her clients are generally first-generation college, first-generation white-collar, and she guides them toward real estate wealth by investing in minority neighborhoods. She has a background as an electrical engineer, but turned to real estate after a layoff, and she invests in working-class neighborhoods in cities all around the country. I was drawn to her story because she shows how you can improve a neighborhood without gentrifying it and how people can build wealth. So, Lisa, thank you so much for joining us today. I love your story because you had that kind of aha moment about real estate investing that I always love stories like that. So can you share a bit of your story and how you discovered real estate?
Yeah, thank you so much for having me on. I've always loved The Motley Fool, and I read all of your articles, so I am very honored to be on today and very excited. So thank you for that. So my story starts with a layoff. Just purchased a condo, and what am I going to do now? But the condo I had purchased was about $35,000. And what really guided that story was the fact that I grew up on the West Coast in Las Vegas. And on the West Coast, you're just not used to very inexpensive homes. It's always more and more pricier, more expensive, right? You really don't see a downward slump. And so when I moved to the Midwest for a job to work, I found out that there's this whole world out there where the prices of home can range from $30,000 to $1 million, but you definitely had a range, and those neighborhoods were actually very decent, very nice. And to be honest, from my own background, the kind of neighborhood I grew up in, because I grew up in a low income working class neighborhood. So when I went out there and discovered this reality, it was just such a beautiful thing to have. I was just laid off, but I had purchased a $35,000 condo, and I had to fix it up. But the thing is, it just taught me viscerally in my 20s that if you own property, even if it doesn't cost much, you're protected from a lot of what the economy has to offer. And if it doesn't cost a lot, you're doubly protected because it's easy to afford the mortgage. And this was during 2009, where we saw a huge number of foreclosures. Even to this day, we're still affected by it. So having that peace of mind and clarity, and the understanding that the neighborhoods that I grew up with aren't necessarily desirable to a lot of white collar workers out there who want to have a certain standard of living, but they are affordable for people who are in that income bracket and tight price range, and we can provide a service. And as you do know, I'm very much not into gentrifying. So I'm quite, so I do make a note to mention we're not going into these neighborhoods to push people out. We've had enough of that. And today, in this new day and age, the people who follow my system are very much concerned and think about not pushing out lower income or working class families in order to make a profit. And so I find that because not only are we looking at the income data sheet, but we're also thinking about community, that we just build a richer business and we each individually build a richer portfolio.
I love that. I think that's really important. The other thing that we're seeing right now too is there's a rise in median home prices. So a lot of neighborhoods all over the country are becoming unaffordable for renters, but also for investors. How are you still finding good deals?
It is a process. You want to look where no one else is looking. So I do have a whole system I developed that goes into this in depth, but you really want to find the major transportation routes strategically from major city hubs. And from that, you could sort of in a systematic way, just go through and start finding these places that are outside the main cities, but do offer decent enough rents, but low enough properties. So it is a system going from high populated area and moving out, but in a strategic manner.
That makes sense. So the other thing I wanted to talk to you about too was the foreclosure crisis, the potential for foreclosures. I don't think that this cycle that we're in is going to be like that last cycle, but there are, as you mentioned, there are still foreclosures out there. How do you work with your clients in kind of walking them through what buying a foreclosure is like?
I love foreclosures. I do not like short sales. So we just really need to separate those two, because I've been doing this for 10 years. I've been working with people all over the country for 10 years successfully. I have not seen one short sale go through for an investor. I have not once. So I do exclude those from what we look for, just because they can get caught up at the last minute in the bank just automatically refusing, it taking 9 months to close. They're just very tricky to get through. So when you exclude those from the conversation and just stick with real estate owned, I love them, because foreclosed property, once it's gone through the entire process, that means the bank has cleared any and all liens. Okay, so that you don't have to be responsible any second mortgages, any mechanics lien, financing lien, all of that has been cleared. They're usually empty and they're ready to be sold for under the market. So I actually love when I see REO, which is real estate owned, or foreclosed, but we want to make sure it does not say pre-foreclosure or short sale. Once you get through that understanding, it really just opens you up to prime houses sitting there under market, undervalued for a quick sale.
Yeah, I think that that's a really good point about short sales. I always think it's so funny that they're called short sales, because they are always so long and so complicated. They are very hard, especially for beginning investors. So when you have a neighborhood that's got a lot of foreclosures in it, you do get that concern about gentrification. You get people wanting to come in and buy up a lot of properties and really change the neighborhood. Why is it important, do you think, to sort of develop a neighborhood respectfully and not change it? How do you stop improvement from becoming gentrification?
So there's a component on why it's a good thing to do, and then there's a how. So the why is a bigger conversation that sometimes people in the financial community aren't so comfortable talking about. And when you mix business, profit, and income, and you also mix that with the spiritual essence of service to the community, service to others, not at the expense of yourself, together, and helping them get stability and helping them create, bringing affordable housing and investments to these neighborhoods, you're really tapping into something it's just more of a higher perspective. You're giving back more, you know that you're making a difference, and you know that you're being in service to humanity. So I do find that when you can not only be profitable, but also do so much more for people than anyone else has done, create a different narrative that really helps people other than yourself, have long-term secure housing that's in decent shape because you're not a slumlord, you're really giving out good karma, good dharma, and that does pay for itself, not only in the people you're impacting, but the impact you're leaving on a neighborhood or location. Because I have 11,000 people in my Facebook group. We have seen such positive changes and reformations in those neighborhoods that we invested in because we do care and think about that, not at the expense of profit, but in conjunction with. So I do find if anyone out there, if you want to make money, but also find a way to make money and be of service to the communities that need someone to be of service, not only do you feel good, they feel good, and the whole planet's vibration may lift. Now that might be too spiritual for you, but it is a real thing that I think sometimes gets overlooked in business where it's just money. Well, no, it's also the energy you put into it is the energy that you get out and can proliferate. And we're proliferating a really good energy of community and thinking a little bit more thoughtfully about what we're doing in these neighborhoods. Now the how, and this is actually a very economic discussion. So many times we talk in our group about how we do not raise the rents on our clients, and that helps slow down gentrification, or at least for that one family or individual property or multifamily that you might have. And there are a lot of benefits, actually. Instead of raising your rents with the market every year, if you keep them below, you tend to keep long-term clients. I call tenants clients because they are my clients. Like, I want to service them. They pay me money. But you tend to keep long-term clients. And when I say long-term, and especially in this demographic, you can talk about 10, 20, 30 years of the same tenant. And if you doubly get a tenant who keeps your place up and immaculate and tells you everything that's going on in the neighborhood, not only that is also a benefit, because in the long run, if you get people in and out, not only do you have turnover costs, which will eat into your profits that year, guaranteed, but you also bring in the possibility of getting a not so good tenant versus a known quantity that keeps your place up and pays on time, right? And even during this economic and this pandemic, we have seen that, right? We still have our great tenants that know that they're getting a great deal, know that if they leave, that it will rise. And so we get good tenants who take care of the place, and we are not doing turnover costs every year to 2 years. So it just stays profitable. And it gives them stability as well. So you might notice when I talk about it, I do talk about what we get, but it's also good if you can talk about what they benefit as well. Because to me, a good business, and this is my culture that I spread, is all about win-win for both.
I really love that. And I think that really shows why it's important to have individual investors. I know one of the things that that happens sometimes is when you get institutional investors, you don't get that level of care, you don't get that level of connection. And that connection really is important when you're talking about having someone care for the property as like it's they're a renter.
Yeah, like if you are this faceless machine, that's what you get back. If you are someone who's a landlord, like, and my tenants haven't even met me, but they do know if they put in a request for something to get fixed, it gets fixed, right? They know the energy. They know when they walked into the place, it might be in a modest neighborhood, but I took the time to put contact paper on the countertops, which is a very low cost way of upgrading the look. Right? They see these little signs of the luxury vinyl tile instead of like that office flooring, which is really cheap. They see these little signs and energy. And so you really do get back what you put into it. And sometimes it is these small little touches, which shows you how important connection is for everyone to be fruitful.
Definitely. So I know you work with a lot with Black investors, and the Black rate of homeownership has been below other groups. Do you think that it's possible to change that, and what needs to happen in order to raise that rate?
That is a big question.
It is.
Okay. I will say there are institutional reasons on why it is at a lower rate. I constantly in my Facebook group, we're sharing stories of how appraisers will appraise a house that has pictures of Black people on the wall, and it's very obvious that a Black family lives there, can consistently be undervalued and underpraised appraisal versus if they take those pictures down. And so a lot of what we have to do is be in the know and know, oh, you're supposed to take any pictures that show that you're Black, you're supposed to take down, right? Like we have to be in this network of like getting around a system that is set up to keep us at a certain economic level and not to prosper. So what does help is being around other investors. So I will tell you in my group, out of all the banks out there, it's like 5% of the banks get all of our money. So in my group, it's like the same, 5 to 10 banks across the country that we all use. Now, on one hand, those banks are making a lot of money because that's a lot of economic power that they're getting. But on the other hand, it shows you what's going on if we can only really work with 5% that are consistent with giving us loan if we have the right credit, versus others, you can be a Black mortgager, have good credit and still get denied. And we have those numbers. Those are out there. It is very obvious that it's like in the nature. Even the companies themselves that are doing this, that'll show, like Banco Santander. I was reading up that 90% of the people they give banks and loans to are white or Asian, right? Not Black or Hispanic. And you can look at those numbers, and even that bank will deny to this day that there's anything wrong with how they're doing it, right? But you already know that we have the studies that show two people, one couple is white, one couple is Black, and they have the same credit profile. One will get the mortgage and one will not. So will it ever change? It will change with us. It will change with people like in my group educating that, hey, not every bank is for us, but these 5% are. And you know what? Those 5% benefit from that concentrated amounts of money coming from the Black community. Because as you know, we do have very large economic power. So they benefit because the other 85, 90% are not good at being diverse and understanding where they may have institutionalized systemic racism, right? So that is sort of how we have been doing it and modifying ourselves around the situation, around this country that we're in. And it's very much an in the know network. It's very much us educating each other and pointing to the few that will treat us very fairly. But I always go back to, you treat us fairly, you get all the business. So, there's something to doing something better than yourself in business that really pays for itself and keeps you in abundance. So will it ever change? Yes. And it'll start from within because the system is so large. I'm not changing Bank of Santander. Bank of America has how many fines and millions they paid for racial discrimination suits that they settled? They haven't changed yet, right? So what we try to do is find the ones we can work with, and those few ones we try to proliferate and word of mouth spread.
I think that's really important. On a previous podcast, we talked a little bit about minority-owned lending institutions and why it's so important to support them and to help them grow. And you mentioned the economic power. It's to everybody's benefit. There's a lot of economic power that these bigger banks are missing out on. It's their loss.
It's ridiculous sometimes when you think about it. So on my platform, on my book, I'm very open. Like, I do have everybody in my group of all races, but I do say I target Black Americans because the neighborhoods we tend to go into in our history, it's just like a nice little symbiotic relationship. And I look around, like, if you guys are sleeping on the economic power of the Black community, that's on you. I guess you don't like being in abundance because it's there, it's known, it's been talked about. And even with my own platform, I have been very well taken care of, just specifically focusing on this one group, right? Even though I do have an umbrella where I allow all in. It's there. It's there. I'm not saying there for the taking, because we've had enough of that, but it's definitely there and it's overlooked. And, but the person who can see a little bit more and be a little bit bigger gets all the revenue. And that's how it should be.
I like that. So you work in cities all around the country. I know some people are worried about investing remotely or investing in a place they don't really know. How do you help people kind of feel comfortable with that?
That is such a good question, because once you get past this roadblock or obstacle or fear, it really opens it out. Because honestly, most of the people I work with, they live in New York, DC, Florida, Atlanta, Texas, and California, places where they earn a nice living because the salary differential is so much higher, but they cannot afford to purchase properties there, especially not rental properties at what would be comfortable for someone first time investing. So once you get past the roadblock of investing remotely, you are good to go. So how we do this is we really start being strategic. So my California clients, I have them focus on the Midwest. If you're in the Northeast, you can focus on the Northeast, and in the South, you can focus on the South. So it's really my Californians that as soon as I talk to, you're from California, I'm like, hey, are you okay with travel? What's your travel schedule? Do you have 2 to 3 days off? And what I want everyone to know out there are ways to do this where it's very systematic. So you don't have to necessarily visit every week. This isn't I bought a cabin in Idaho. We have to go out there to fix it up. No, what we do, we're very strategic. We look at the closest places you can fly into. We look at markets that have houses in the price range that we're looking for that don't need much work, right? And we're also looking at multifamilies. So there's different things that we do to eliminate our risk. And one of the things is, listen, you fly out of Jacksonville, Florida airport, right? Where are the first direct flights on the low-cost carriers? Because the low-cost carriers tend to go to low-cost markets. So, I mean, it could be something that might be, oh, that makes sense. But if you put a whole bunch of those little things together, it really is a lot easier than you would think to find a market affordable to fly to that has the houses you want and create a nice little system of between the contractors and property managers and you of being informed where you don't have to be there every week. I just had a client go out to Wisconsin and purchase 2 multifamilies. And I think she's visited 2 times, right, in 3 months. But if you set this up properly, you don't need to visit because you've been very diligent about making sure the market can sustain that it has good contractors already, that it has good property managers, and it has more than one property manager. Because if you're an investor, you know, the first one might not be that hot. Okay. And so you need to make sure it has 2, 3, or 4. If you work with me, I say it needs to have at least 4 because I'm on my 3rd property manager on my Ohio property in 9 years, and that can happen. So if you go to a place that's, oh, look at this cute little house, it's $40,000 in a rural area, but there's no one to manage it, I have to tell them we have to keep going unless you want to manage it yourself. So when you really get really, really firm and disciplined on those little details, it can make it a lot easier and a lot smoother than people think. And that is the biggest part of what I teach people, so they can get started in real estate investing at a more affordable price point for their first investment.
Fantastic. That note about low-cost carriers and low-cost markets is such a great thing that most people wouldn't think of, but makes so much sense.
Right.
Well, let's take a break here. And then when we come back, we're going to talk about some of the specifics of how you find tenants and working with property managers. During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from and probably dozens, if not hundreds, of real estate companies that are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Well, I think the number one benefit is from day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates on, and talking about the real estate market. So it's really the full package if you're interested in real estate investing.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. We're here with Lisa Phillips, who runs affordablerealestateinvestments.com, and she works with empowering first-time investors to own rental properties. So, Lisa, you are a great mentor, and you work with thousands of people. But how did you find your first mentor?
As all of my stories, I was laid off. All of my stories start like I got laid off, and then it was time to get to work, right? I like money and I like being in a house. So I was actually laid off, and my first mentor is actually a coaching mentor. And at that point, I had been helping people individually with their houses who maybe reached out to me through Bigger Pockets or maybe saw a blog post. And he was amazing. God sent him to me, I swear, because he just helped me reformat everything. And I was able to give to more people in a more polished manner. And the more polished the manner was, the more they can believe in it and appreciate it and have a structure that worked for them. So that was my first and not my last. I consistently have a mentor either for business or for spiritual purpose, someone who's better at their craft than I am. And I'm trying to constantly evolve and do better. So that is how it happened. I was laid off and I was like, let me see if I can build this online platform of helping people with their first rental properties. And, that was 2015. And, everything else has been history since then. So he was a godsend.
Yeah, mentors are so important. And I wanted to talk a little bit more about your strategy, because I think it's really important that what you do is that you don't sort of ladder people up into buying more and more expensive properties, which I've seen a lot of other real estate investors do. And sometimes that ends up putting you in a position where you actually have properties that can be a little kind of too big for your portfolio. So why do you think it's important for investors to have, basically workforce housing, more reasonably priced properties?
Okay, so you're gonna have to get some dose of real. I'm gonna be very real with you guys right now. Honestly, like, in order to understand this, you got to understand that the people who are traditionally in giving real estate investing advice were in a different socioeconomic class. Okay, they were in a socioeconomic class where putting $50,000 down on a $200,000 or $100,000 property and waiting 30 years for it to be paid off and then get the rents was something they can do because of the amount of money they have. They weren't necessarily looking to live off the income. And for a lot of people in that social class, they were not comfortable going to lower income or working class neighborhoods, right? They just didn't have the mindset, the familiarity. And so when you understand that context, you see why that was the proliferating thought. Yeah, you buy this expensive property, hold on, it'll be more expensive, right? But that's 20% of any audience, right? The other 80% are working class smos like me who are like, okay, why would I do this? Why would I put that much money down to have a $1,400 mortgage to wait 30 years in order to have, a house that might be worth $400,000 or $500,000? Like, yes, we obviously understand that there's a lot of equity, but unless you're really flush with cash, like a lot of the investors tended to be, it just really doesn't make economic sense to hold on to something like that for 30 years. And so when I came on the scene, I was like, look, I'm from these neighborhoods. I'm comfortable. The people I target are very comfortable. So, why not? And it's just so funny to us. So at the end of the day, I've been doing this for, 2013 is when I started out on YouTube. And to this day, there are people who are like, I will not step foot in the neighborhoods that Lisa promote. And you know what? That's okay. Because if you're not comfortable in it, they'll know you're not comfortable. And they'll think it's because of thisism or thatsism or classism or racism, right? So it's okay for you to stay in your expensive property if that's what you're comfortable with and if that's what you can afford. And so I just like to be the contrast. There's those of us out there who do not have generational wealth, okay? Whatever wealth we have, I literally created it over the last 10 years of just working very hard. There's no loans from mom, there's no loans from dad. I'm not going to the local church and someone's going to give me $50K. That does happen in certain communities. It's not necessarily happening in mine. And so it just makes sense for who and what we are. So I think the biggest part is just acknowledging like what social economic class are you in? And so follow the advice that sort of works for what you're trying to do and what you're comfortable with. I'm comfortable with these neighborhoods. You know, you could start with 10, 20, $30,000, which is a lot more doable for first generation college, first generation white collar. And personally, I'm all about buy low, sell high. So they can keep their strategy, which I understand comes from a place of their comfortability and access to capital. But I just want people to be educated on why that would happen versus this other one, which works for, I think, the majority of people who are more modest of what kind of cash capital that they might have access to. So that is where we stay in our lane and they stay in their lane.
Well, yeah, it's all about finding out what works for you. And there's also a benefit to just having steady, consistent wealth over time. I mean, that's how you grow a business. You don't necessarily have to swing for the fences every time. There's a lot to be said for, a small amount of consistent income that comes in.
It's been amazing. And so with these portfolios, I did find all of a sudden, I sold one and I was like, oh, look at that. For the first time, I'm one of those people who have X amount of money in the bank, right? So if there was a bigger deal, I can put down the $50K to buy a bigger deal. But it was these small little things that added up over years. And then you look back, you sell one that maybe appreciated, and all of a sudden you're a bigger player, right? Through those small little diligent plays that you've been making.
So when you're looking at these homes, you're looking at lower priced homes. Is there ever anything that for you is a deal breaker? Are you looking at things like plumbing or electrical? Are you mostly looking for homes that need only a small amount of improvement?
It depends on, that's a bit of a bigger question. For the most part, my non-negotiables are any foundation issues. We're not doing that. It's just too expensive. There's too much unknown, and too many variables with that. Also, in these locations, crime is something you have to consider. I know there's some really cute houses in these price ranges, but if they are shooting in front of the house, it's not worth it, right? It's not worth it. Or maybe it is to you if you're like G.I. Joe. But we really have to be discerning that we don't just chase a low cost property, and we're very mindful. And as you said, the gut rehab. Now, there are times where a gut rehab is worth it. Say it's a neighborhood where across the street, they're building like a $40 million megaplex, right? And then taking that shell and putting 50 or 60K into it is worth it because across the street, you have this huge development that's going to bring the value of your home up, right? But if it's not that particular upshot or situation where you're going to get that extreme appreciation, I would not recommend the full gut rehab. It can work in certain situations, but since we're not flipping and we're really trying to make sure that whatever we put into it, the rents match it, plus give us cash flow, that's something we have to be very discerning about.
Well, you also mentioned before having multiple property managers. So how do you find a great property manager? What do you look for? Do you want to work with an individual? Do you like to work with a team? What kind of works for you in finding a property manager?
This is the best question because what I tell my clients when we start out, let me tell you something. Every property manager says they're the best property manager.
True.
Everyone says they're good. Everyone says they're going to treat your property like the best. The reality is when you get into investing, you really start realizing it's mom and pop, it's character-based, it's individual. So that individual who said they're going to do everything right may, in fact, do everything right, but they may, in fact, be terrible communicators, not really good at scaling their business. Or I've had people where they started out great, but then I recommended them on my platform. And then all of a sudden they weren't so great because they had too much business and they couldn't scale with it properly, right? And so what I say that for is because everyone's going to say they're the best. Just like when you're interviewing someone for a job, every candidate that comes in says they're the best candidate. But and what I tell them, we just have to be discerning to know that we're not going to know how they function until we get in bed with them. Until they start working with us, we're not going to know. Everyone says they're great. And so when I tell them that, I go, you just need backup and resources. You might find out 6 months in that they're not the best, but if you already chose a market and you knew that there were 4, 5, or 6 other property managers you can go with, it hurts less because you're not stuck in a position. So if in 3 or 6 months you find out they're not collecting rent, they're not getting any phone calls, they're not doing the work they need to do, or they charge too much, because I had to get rid of one because they charged too much for everything. It's like, it does not cost that much for this, right? And so there's all these reasons that might go into why you're not quite satisfied. But each time I, closed out whatever contract, if any, I had with them, and I had the second property manager go pick the keys up from the previous manager that I just let go and continue on in the business, right? So part of it is making sure that there's enough and understanding that we don't know if they're going to be good or not until we start working. And I know we want certainty. I know we want to know that they're going to be good. You're going to have it your way, but that's just not how real estate investing works. That's why you go to a contractor. Are they going to be good? Are they not going to be good? Right? Like, you want the certainty, but it's not there. But what we try to do is mitigate our risk and give ourselves options and minimize how much overhead or over leveraged we are. So if we do find out early in the game, either with a contractor or with a property manager, that they're not the best, we have exit strategies to switch over, right? So that's how we try to mitigate the risk that goes into that.
Interesting. So when you're trying to get tenants, and I know you call them clients, but when you're looking for someone to be inside the house, do you have the property manager do the screening, or do you do it yourself? And is there anything that you've learned is sort of like a red flag that probably people may not be aware of?
Okay, so it will depend on the property manager. I have one property manager who's amazing, and she's like, I'm deciding because I have to deal with them. She told me that, and she's amazing. So I'm like, okay, girl. So she was like, I don't accept this, I don't accept that, and she has a great tenant. I've had them for about 6 years so far, and they're still there. And then I have other property managers. Well, they'll compile the information and send it to you. They might give you their thoughts, but you are the ultimate decider after seeing their credit report and the full application. So it really just depends on that particular location, if you're doing the work yourself or working with the property manager. The biggest thing I have noticed in my experience is you can have a ding or something, one or two things bad on your credit, especially in this price range and, working class neighborhoods where, the funds are not so flush and plentiful. So you're going to see maybe some blemishes. But one thing I have noticed directly correlates to them not paying rent is how many charge-offs they have. So a charge-off on the credit report is a very technical term, meaning they did not pay, didn't attempt to pay, and they just charged it off, right? So there's other type of negative items on a credit report. But I've noticed there's a correlation. If they have multiple charge-offs, they are not going to pay you rent. They are okay with not paying something, having it out there, and just sitting there. And I had to learn that the hard way, but that's what we do. We learn the hard way so we can tell other people. So that's one of the red flags, the charge-offs. But pretty much a lot of people at all income and price ranges might have one or two blemish. So the charge-off is my biggest thing. So the other big thing is that you want them to make 2.5 to 3 times their income. Because I've had people who like my properties because I do put these little small touches in it to make them look so nice for that neighborhood, right? And they're very budget minded, but they come and they want in, and I look at what they're making and I was like, y'all, you just don't make enough, and you can take them because they really want it and you feel that energy, but you also have to understand it's going to put both of you guys in a bad situation. If they literally cannot afford this and their other expenses, when it comes down to it, there's going to be other expenses that come first. And you're putting them in a tight position that you should have known better as the landlord to circumvent. And for you, why deal with the anxiousness? So the 2.5 and 3 times the rent has been very, very a consistent, stable way of making sure we get really good, consistent tenants. So the charge-offs are one thing, and being very strict with the 2.5 to 3 times the income.
I think that makes a lot of sense, the charge-offs versus the credit score, because the credit score can mean, one or two things happen. Certainly, I think just about all of us when we're younger, we make dumb decisions with credit. And so that can affect people. But yeah, a charge-off really says that they are comfortable with what happens when you don't pay. And that's that tends to mean it's someone who maybe isn't going to care about the property the same way you are, and won't have a problem with just walking away with it in any state.
Right. A little too comfortable not paying people. So so that's one of the things. You're correct.
So as we wrap up, I wanted to ask you for one piece of advice that you think that you give people that maybe they tend to ignore when they're first-time investors.
I don't just see one thing. I see a couple of different things. One of the things I see that I tell them to stop doing is sometimes they're like, oh, I found a random house that's like $50,000 on Zillow. And they get fixated on a random house. And I'm like, what market is it in? What's going on in this market? What's the economy? What's the neighborhood like? What's this? And I start actually asking them questions and trying to vet. And they're all over the place, just looking at cheap houses, but not being discerning, looking for the right market and making sure the right market has the right kind of house for their budget, right? It's a little different, more nuanced. So I tell people, don't just focus on a cheap house, okay? Look for the right market that has the kind of houses you want, which is more, and those are the skill sets that I teach people. But I do sometimes have clients who think they know more than I do when they find out a couple weeks in that, okay, let me just go back to finding the right market because I'm all over the place and I'm not getting anywhere. So that's one thing that I have to sort of wait for people to find out on their own that they should listen to, because the right market will have all that. We've already vetted that it had properties in this price range, right? And I would also say energy. So I've sort of dropped in and through here that business can be more than business. You can bring a higher aspect and a higher perspective to it. And one of the things I try to tell people, and some resonate with immediately and some have to come around to, is that the energy you put into it is the energy that you get out of it. So if you think you can't, you can't. If you come to this optimistic and going, I couldn't necessarily find this myself, but I believe they're out there. I'm seeing other people in your Facebook group post and they're optimistic and they have that energy of like, well, why not? This could definitely happen for me. They do a lot better than those who have a little lower energetic presence. And they're like, I couldn't see it. Do you think I can if I work with you? Or just, they couldn't do it and they're just mired in disappointment. And then they get more disappointment. And I might have a coaching call where I have 3 people looking in the same city. And the one that was like disappointed from the beginning sees nothing. And the other 2 have like 10 properties we're analyzing and looking at together to see which ones they want to buy. Right. And so that's something that not everyone can get or pay attention to, but the energy in which you show up to do your business in is the energy in which you get back. So you show up to just start your business and you are ready to go. And you're like, why can't this happen to me? Why can't it be my lucky break? Of course it can. I find that not only do I like working with them better, but they get exactly what they're expecting. But I also notice that if they show up and their energy is like, I don't think this could happen. I don't think this can do it. Sometimes I tell them, well, maybe you can take some time to think about it before joining. But I do find that your energy will bring to you what you put out. What your expectations are is exactly what you get. And it's just something that some people just can't really understand at the point that they're in right now. So I try to say something. Maybe they get it. They don't. Eventually, it'll work itself out.
Well, I think that also reminds me of some of the case studies that I read on your website. And I think that one of the things that I really loved about reading some of those case studies was that there were people who wanted to build wealth. That was obviously important to them, but they also wanted to give back to their community, or they wanted to give back to other communities that they saw that there was a potential to both do well for themselves and also do good for other people. And I think that's an important thing in rental investing is that you actually are elevating a community. You talked before about making those nice little touches in a house and how that level of care, people feel that care from an energetic standpoint. So I think that's really important.
And it's just a conversation that up until now wasn't really being spoken about loudly, but now it's time to be loud. And especially in the current climate, right? Where, there are governments talking about you don't get to evict anyone, even if they don't pay for a year, right? Like we're in this climate right now where the tides are really turning towards a disregard for landlords and more regard for tenants. And so if your individuality of your portfolio, caring about those little things, means that during this economic downturn, your client wanted to stay with you, communicated with you because they know what they're getting compared to the other people. Like that's your difference in weathering the storm. And I have a Facebook group of 11,000. And during this pandemic over 2020, I asked them, how's it going? And they might've had like one client who was already trouble that they sort of let go, but 75% to 80% and 100% of my portfolio, it's been okay. Right. But the thing is, it's something that you've invested in and you put all that care and energy in. And so when SHTF happens, right, all that work and energy you put into it pays for itself. It's something that not everyone can see because it's not necessarily immediate, but you are correct. The energy you put into it is the energy you get out, and it can really help when you go through the bad times. And I tell you in my group, we are doing okay. That is not the same for every other group. It really isn't.
So let's give people the name of your Facebook group. So, and can anyone join?
Yes, it is the Sub 30K Mastermind Group. I can send you a link so if people want to join, which is really good because then you can see what people are doing all over the country, what the houses look like, what the price ranges are.
Perfect. Well, great. Yeah, we'll put that in the show notes. So thank you so much for your time today. I think this was really very, very helpful for people. And just to remind everyone, you can always find out more about rental properties on millionacres.com. And please check out Lisa Phillips on affordablerealestateinvestments.com. Thank you.
Thank you so much, Deidre.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.